All right, let's dive into Longeveron, ticker LGVN, and their Q3 2025 earnings. Now, if you listened to the call, you heard a story about a company on the brink of something huge. But then you look at the stock, and it's a totally different picture. The market absolutely hammered it. So what's going on here? We're going to break down the numbers, the story they're telling, and figure out why there's such a massive disconnect.
Okay, let's get right into it. We're starting with the hard numbers because honestly, one look at these financials and you'll see exactly why investors got so spooked.
First up, the earnings per share, a loss of 39 cents. Now, the street was expecting a loss, but only around 26 cents. So this wasn't just a miss, it was a big miss. And what's worse, it shows their losses are actually getting wider, not smaller. That is a huge red flag.
And then you look at the top line, the revenue. For the entire quarter, they brought in just $140,000. I mean, think about that. That's not just a miss. It's over 50% below what Wall Street was looking for. And maybe even more shocking, it's an 82% collapse from where they were this time last year. Ouch.
So this table really lays it all out in black and white. You can see the problem clear as day. Revenue is down, and I mean way down, 82%. At the same time, their net loss has ballooned by 64%. It's the worst of both worlds. They're bringing in less money while spending a whole lot more. The 9-month trend tells the exact same story. They're just burning through cash at a really alarming rate.
So, you look at those numbers and you have to ask, how is this company even still standing? Well, it's all about the story. Management's playbook here is to get you to look past the ugly financials and focus on the promise of their future, their scientific pipeline. So let's do that. Let's look at the bull case they're trying to sell.
And this is it right here. This is the core of their entire pitch. It's all about their main drug, laromestrocel. It's what they call a platform asset, meaning they're testing it for a bunch of different things. The one furthest along is for HLHS, which is a really severe heart defect in babies. It's in a pivotal trial. That's the last major step before you can ask for FDA approval. And the early data, 100% 5-year survival rate. I mean, that is absolutely incredible. Add in some positive data for Alzheimer's and a ton of support from the FDA. And yeah, on paper, this pipeline looks like a home run. It's exactly what you want to see.
And of course, the interim CEO, Then Pao, really hammered this point home on the call. He kept talking about how the next 9 months are going to be transformational, how it's an exciting time. This is the vision, this is the dream he's selling to convince everyone to hang on.
Okay, so that's the dream. Now for the reality check. Let's pivot from that really promising story and get back to the cold, hard numbers on the balance sheet. Because look, it doesn't matter how great your science is, if you run out of money, it's game over. And Longeveron is running out of money, fast.
And that brings us to the one question that really matters right now. It's the elephant in the room that just completely overshadows all that cool science. Can they actually afford to see this pipeline through? Can they get to the finish line?
You want to see the problem in a nutshell? Here it is. It's like the jaws of a crocodile closing in. On one side, you have their spending just skyrocketing. R&D costs alone are up 52% as they push these trials forward. And on the other side, their revenue has basically vanished into thin air. You can't run a business like this. It's completely unsustainable.
So where does that leave them? Well, this unsustainable cash burn leads to a very, very scary deadline. And this isn't us guessing. This is straight from the company's mouth. Their cash runway ends in late Q1 2026. We are talking just a few months away. The pressure to find money and find it now is absolutely immense.
So you've got this incredible story, right? A story of amazing science versus a story of looming financial disaster. It's a classic battle. So which story is winning? Well, the market is the ultimate judge and jury. So let's take a look at the stock chart to get the verdict.
Yeah, this chart pretty much says it all, doesn't it? The broader biotech sector, the IBB, has been on a tear, up over 20% in the past year. It's been a great time to be in biotech. But Longeveron, it's been absolutely crushed, down 66%. And look, this isn't just a blip from one bad quarter. This is a sign of deep, ongoing skepticism from the market.
So why? What is driving this massive underperformance? It all comes down to 2 words, dilution risk. And the best way to think about it is with a pizza. Imagine you own 1 slice of an 8-slice pizza. Then the company says, hey, we need cash. So they recut the whole thing into 16 slices and sell off the new 8. You still have your 1 slice, but now it's a much smaller piece of the pie. Your ownership has been diluted. That is what investors are terrified of right now. And there you have it. That's the market's verdict. Investors are looking straight past the CEO's optimism, they're looking past the genuinely exciting science, and they're focused on one thing: the high probability that this company is about to raise cash. And when you're desperate for cash, you don't get good terms. The market is pricing in a painful, dilutive capital raise, and that's why the stock is where it is.
Okay, so that's the lay of the land after Q3. Now it's time for our take. For the next call, we're going to put it all together, assign a rating, and even walk through a potential trade idea.
And just in case you think we're exaggerating the urgency here, check out this quote from the CFO, Lisa Lyer. Now, CFOs speak very carefully, but reading between the lines here is easy. She's basically saying, if we don't find money, we have to start shutting things down. That is code red. The stakes really could not be higher.
So how do you even think about trading a situation like this? Well, here's an outrageous but plausible playbook. Step 1. You just wait. You wait for the financing that we all know is coming, probably by early 2026. Step 2. You scrutinize the deal. If it's as ugly and dilutive as the market fears, that's your signal. Step 3. This is the aggressive part. You could consider a speculative short position heading into their next big data readout. The bet here is simple. You're betting that the financial overhang will crush any good news from the science. But, and this is a huge but, Step 4 is the escape hatch. If they somehow pull a rabbit out of a hat and land a non-dilutive partnership, this whole short idea is toast. You have to throw it out the window immediately.
So when you put it all together, our rating for the next call has to be underperform. Look, the science is really cool. The pipeline has genuine potential, no doubt about it. But the financial situation isn't just a problem, it's an existential threat. At this very moment, that near-term risk of a brutal capital raise just completely overshadows the long-term promise.
And of course, we have to end with this very important reminder. This is not financial advice. Everything we've talked about here is for informational and educational purposes only.